Ever feel like you're just drowning in reports, news, updates, trying to figure out what actually matters about a company? We get it.
Yeah, information overload is definitely real.
And that's precisely why we do these deep dives. We try to cut through all that noise, take the sources you give us, like this Compasscope report, and pull out the must-know insights.
Think of us as your navigators, really. We're here to guide you through the crucial details so you can get up to speed quickly but thoroughly. Today, our focus is Zimmer Biomet. ZBH is the ticker.
Right, a really significant player in medical devices, specifically orthopedic reconstruction. And like you said, our guide is this comprehensive research report from Compasscope, plus their latest business updates, especially that first quarter of 2025.
And our mission is pretty clear. We want to distill the essential info, give you a sharp picture of what ZBH actually does, how they stack up against competitors, where they see growth coming from.
The hurdles they face, and what their latest performance tells us. Basically giving you the valuable nuggets, not just a data dump. Let's unpack this.
Okay, so at its core, Zimmer Biomet is really about improving lives through orthopedic surgery. Their products are aimed squarely at alleviating pain and restoring mobility.
And their foundation, historically at least, is those big joint replacements, right? Hips and knees.
Exactly. The reconstructive product segment is the backbone. This covers their hip systems. You mentioned the Z1 triple taper stem. They have cementless options in knees. Big focus there on the Persona OsseoT cementless knee.
I've heard about that one.
Yeah, it's key. Plus revision systems, the Oxford partial cementless knee, and they also cover shoulder, elbow, and other extremities.
But the business is, it's clearly evolving. It's not just metal and plastic anymore. The tech side seems huge.
Oh, absolutely. The robotic and digital platforms are now central. ROSA Robotics is the major player knee, hip, even shoulder procedures now.
ROSA, okay.
And they've got other interesting tech too, like Persona IQ. That's a digitally connected knee implant.
Wow, captures data.
Yeah, captures data post-surgery. Then there's Hip Insight for mixed reality guidance in the OR, and OrthoGrid, which they acquired, that brings AI into hip navigation. This whole tech ecosystem isn't just cool, it's, strategic, makes things sticky.
Right. And beyond those core large joints, they built up this other area, SET.
Yeah, SET stands for Surgical Sports and Extremities. This is really key for diversifying the business. It includes sports medicine,
CMFT.
craniomaxillofacial and thoracic trauma, and that big acquisition they did, Paragon 28, really beefed up their lower extremities business, foot and ankle especially.
Okay, interesting. And then there's this other bucket, technology, data, and bone cement.
Right. They actually just renamed that group recently to better reflect how important data analytics and digital tools are becoming. Tools for workflow, outcomes analysis. Bone cement is still fundamental, of course, but the digital shift is clear.
Plus the sort of everyday ortho stuff. Trauma products.
Exactly. Plates, screws, devices for fracture repair, necessary stuff.
And strategically, looking ahead, they're really focused on two growth areas, emerging markets and these adjacencies.
Like foot and ankle from Paragon 28.
Yep, building that out. And also really tailoring products and solutions for ambulatory surgical centers, ASCs. These lower-cost outpatient centers are becoming a much bigger deal.
Okay, so that gives us a good picture of the different parts of Zimmer Biomet's business today. Now let's shift gears. How do they stack up? Who are they really competing against, and what's their edge?
Well, the orthopedic market is definitely competitive, think heavyweights. But ZBH has this significant structural advantage, surgeon loyalty.
Really? How strong is that? It's just habit, or?
It's remarkably sticky. The Compasscope report points out surgeons often stick with one vendor system for like 5 to 15 years. They might do 95% of their procedures with that one system.
Wow, 15 years.
Yeah, the switching costs are just really high. Think about the time, the training needed to master a whole new set of instruments, new techniques, the whole workflow. Okay, that explains why market share doesn't just flip overnight.
Exactly. So that loyalty plus their IP protection on products gives them a pretty strong competitive moat. And then there are the intangible assets, their leadership with RSA Robotics, those advanced cementless implants like Persona OsseoT, the Oxford, and just their long-standing reputation.
And their finances seem solid too, based on the report. Low debt.
Relatively low, yeah. Around 1.9 times leverage, the report says. That gives them flexibility to invest, make acquisitions like Paragon 28. And they've done a good job building that product ecosystem, bundling the robots, the digital tools, the implants. Makes it harder for customers to switch away.
And the Paragon 28 deal plus their strength in ASCs, those add to the positives.
Definitely strengths. But it's not all sunshine. They face constant pricing pressure from hospitals, insurers. That's a given in healthcare.
Right.
The report also notes maybe a bit of an innovation lag sometimes, especially compared to someone like Stryker, who's been really fast rolling out new cementless stuff and pushing their Mako robot.
And you mentioned regulations earlier.
Yeah, things like global device registries are adding complexity and cost. Plus, they've had operational hiccups like those supply chain issues tied to their ERP system implementation last year. That caused some headaches.
And competition in related areas.
Right, players like Stryker and Smith Nephew are pretty strong in adjacent fields like sports medicine.
Okay, so let's quickly compare them to those key peers mentioned in the CompuScope report. Stryker first.
Stryker, yeah. Often seen as the main rival. They're strong with Mecha Robotics, got faster adoption there. They command premium pricing, and they're also big in ASCs.
Downsides for Stryker.
Well, that premium price can limit them where cost is the main factor, and maybe they're a bit overly reliant on Mecha's continued success.
Okay. What about DePuy Synthes, the Johnson & Johnson company?
They get a huge advantage from J&J's overall hospital relationships, very broad portfolio, but the report suggests they're maybe lagging a bit in robotics innovation compared to ZBH and Stryker, and perhaps less focused on that ASC growth trend.
And Smith Nephew.
SNN is stronger in those adjacent areas, sports med, wound care, but their challenges are maybe smaller overall scale, which can limit pricing power, slower robotics uptake, and just not quite the same breadth in large joints as ZBH or Stryker.
So summing up the competitive picture.
ZBH looks like it has a very defensible core business. That surgeon loyalty is key, plus the growing tech ecosystem with ROSA and Persona IQ. Expanding in ASCs is crucial. Stryker is definitely the main threat. Pushing hard with Mako and overall growth. J&J has breadth, but maybe less disruptive innovation right now.
Yeah.
SNN is more focused on its niches. ZBH's edge is solid, but yeah, under pressure from pricing and needing to avoid those operational stumbles.
Okay, got it. So with that competitive landscape in mind, how is ZBH planning to actually grow? What's the strategy moving forward?
It looks like a multi-pronged approach, really aiming to take share and boost profitability. A big piece is that robotic and digital platform strategy we talked about.
Really leaning into ROSA and that whole ecosystem.
Exactly. The idea is more ROSA use leads to better surgical precision, which drives adoption, which then pulls through sales of their specific implants designed for the robot. Plus, they're expanding ROSA shoulder, hip applications, adding features like optional CT scans to make it easier to use.
And the shift towards cementless implants fits in here too.
Definitely. Persona OsseoT knee, the new Oxford partial cementless knee, these are central. Cementless implants usually command a higher average selling price, so as they gain traction, that boosts revenue and margins.
And the ASC market seems absolutely core to their growth plans.
Oh, critical. They are aggressively targeting these outpatient centers. Projections show a big shift of procedures moving there, maybe 40% to 60% over time. ZBH already gets about 20% of its U.S. revenue from ASCs, and they're tailoring offerings just for them. Huge runway.
They've also got a pipeline of new products, right?
Yeah, planning over 50 launches in the next 3 years, trying to fill any portfolio gaps, bring innovation, things like that Z1 hip stem, the Persona revision system for complex knee replacement.
And Paragon 28 plays into this diversification idea.
For sure, it's smart market diversification. Paragon 28 gives them a strong entry into the faster growing foot and ankle market that's like a $5 billion market, so they're less reliant just on hips and knees.
And finally, the less flashy but still important stuff, operational efficiency.
Right. Optimizing the supply chain, bringing down those high inventory levels we mentioned, using data analytics to run things better. The goal is better free cash flow and hitting a long-term operating margin target somewhere in that 28% to 30% range.
So how realistic does this strategy sound? Can they pull it off?
The report suggests it's achievable, but, not without challenges. It really relies on that surgeon loyalty holding up and seeing continued adoption of key platforms like ROSA and Persona OsseoT. And Paragon 28's success depends on smooth integration and actually realizing those cross-selling synergies, especially into ASCs.
Which leads us nicely into the flip side, execution risk. What could go wrong?
Exactly. Planning is one thing, doing is another, and ZBH has some specific risks to manage.
We touched on the operational issues. The ERP system.
That's a big one, the ERP implementation challenges. Problems there caused a noticeable revenue headwind last year, about 60 to 80 basis points, according to the Q1 call. It just highlights the risk in their basic blocking and tackling supply chain distribution.
And launching 50-plus products?
Yeah.
That sounds like a massive undertaking.
It is. Product launch timing is crucial. Getting surgeons trained, driving adoption quickly for things like the Oxford partial cementless or the Z1 hip. Any delays there can really hurt momentum.
Their big bet on ASCs must carry risk too, if that market doesn't grow as fast or they lose share.
It definitely does. ASC growth dependence. They're a leader now, but scaling means navigating a really competitive space and making those partnerships work. Relying heavily on it means they have to execute perfectly.
And integrating Paragon 28, that's never simple.
That's the integration risk. Bringing that company in smoothly, keeping the sales team motivated, capturing the synergies they planned for, it requires very careful management.
Plus, just the day-to-day fight against competitors.
Right. Competitive pressures. Especially from Stryker. It's just hard to gain share quickly in a market that shifts slowly because of that surgeon stickiness. And finally, those increasing regulatory compliance demands globally adds complexity, adds cost.
How do these risks stack up against their peers, would you say?
The Compasscope report seems to view ZBH's risks as moderate overall, maybe slightly higher short-term operational risk than Stryker because of the recent ERP issues, but probably lower risk than, say, Smith Nephew, given ZBH's scale and robotics position. J&J has different kinds of risks, maybe more around innovation pace and managing its sheer size.
So hitting their targets really comes down to nailing these specific operational launch and integration challenges.
Pretty much. Okay, so what's the latest? What did the Q1 2025 updates tell us about how we're actually doing?
Sounds like Q1 was pretty decent, all things considered.
Yeah, they reported 2.3% constant currency sales growth. Adjusted EPS came in at $1.81, and they generated strong free cash flow, $279 million. They did mention having one less selling day, which was a bit of a headwind.
Where did the strength come from in Q1?
U.S. hips looked good, up nearly 4%, driven by new stuff like the Z1 stem, HAMR, Orthogrid. And interestingly, they said about half the U.S. surgeons adopting Z1 were actually converts from competitors. That's a good sign.
U.S. knees was a bit slower, though.
Just 0.2% growth in Q1, but they expect that to pick up through the year. Persona Osseoti cementless is getting more traction, about 25% U.S. penetration now, and the Oxford partial cementless knee is just starting its full launch.
And SET kept rolling.
Definitely. Up 4.9%. That's the sixth quarter in a row of mid-single-digit growth or better. And now, with Paragon 28 closed, SET is actually bigger than their hip business. CMFT and sports were strong within that.
The technology data bone cement group dipped slightly.
Down about 3.5%. They said it was mainly tough comparisons to last year and also a mix shift, more RSO placements versus outright sales in the quarter.
Any updates on the operational side? Inventory.
Yeah, good progress there. They're bringing inventory down. Cut days on hand from over 400 early last year to around 370 by end of Q1. Still work to do, but moving in the right direction for cash flow.
They also talked about strategic focus areas moving forward.
They did. Mention adding new leadership, optimizing U.S. sales channels, like specializing the ECT team more, putting more muscle behind robotics and ASC support. Said these changes are within current guidance.
And they framed their innovation strategy around solving 4 key problems. What were those?
Right. First was patient awareness, trying to address the fact that many osteoarthritis patients don't know their options or delay seeking care. Using digital marketing, direct-to-patient stuff.
Okay.
Safety, specifically targeting prosthetic joint infections, PJIs, which are a huge deal. They're working on iodine-coated implants, potentially game-changing launching in Japan late this year, planning a U.S. path. Also focusing on faster surgeries to reduce infection risk.
Third problem.
Efficiency. Making things easier for surgeons and hospitals. Using smart implants to capture data, allowing optional CT scans for RS, using AI tools like Orthogrid. Basically, faster surgeries, lower burden of care.
And fourth.
Improving patient outcomes and satisfaction. The Oxford partial cementless knee is a great example here. They highlighted recent data showing better long-term survivorship than older cemented techniques. That's a direct patient benefit.
They sound really positive about that Oxford partial knee launch.
They do. It just got PMA approval in the U.S., apparently the only cementless partial knee with that. They're training hundreds of surgeons, aiming for over 1,000 by year end, expecting significant adoption.
And any update on the Paragon 28 integration? How's that going?
It closed April 21st. And the word from the company was integration is going far better than expected. They kept the leadership, the whole U.S. sales team, minimal disruption, trying hard to preserve that entrepreneurial culture they bought.
Okay, let's quickly hit the updated financial outlook for 2025.
Sure. They kept the organic growth target, 3% to 5% constant currency. Paragon 28 is expected to add about 270 basis points on top of that for total reported growth of 5.7% to 8.2%.
Currency turns into a slight positive.
Yeah, FX now expected neutral to maybe a 50 basis point tailwind. Better than previous guidance.
Adjusted EPS guidance.
Updated to $7.90 to $8.10. That range includes the hit from tariffs, which they think they can fully offset with FX, cost cuts, etc., and some modest initial dilution from Paragon 28. They expect Paragon to be neutral to EPS by the end of year 2.
Free cash flow guidance came down a bit, though.
It did. Now, $750 million to $850 million. They pinned that reduction roughly 50-50 on the tariff impact and one-time costs for closing the Paragon 28 deal. Those closing costs shouldn't repeat.
Operating margins expected down a bit for the year.
Yeah, about 100 to 150 basis points versus 2024. Again, tariffs and Paragon 28 integration costs are the main drivers, but they expect margins to be a bit better in the second half than the first half.
And the expected cadence of growth through 2025?
They expect stronger organic growth in the back half, mainly because the comparisons to last year's ERP disruption get easier. Q2 organic growth should be slightly better than Q1, despite some tougher comps.
Those tariffs sound like a real headwind to manage.
They definitely are. They're calling for a $60 to $80 million operating profit hit in 2025, mostly landing in the second half. They have mitigation plans, but they did caution the 2026 impact could be higher due to annualization and potential retaliatory tariffs. China is the biggest exposure.
Okay. And finally, M&A. After Paragon 28, are they pausing?
Doesn't sound like it. They emphasize the balance sheet is strong, leverage is manageable, and they have plenty of ammunition for more smart M&A. Said it's their #1 capital allocation priority.
What areas are they looking at?
ASCs, SETI, other faster-growing ortho areas, data and tech. The goal is to get the company growing consistently at that 5% market rate by 2027 and even higher by 2030.
All right, so pulling all this together, based on the CompassScope report and these updates, what are the absolute key things you should be watching with Zimmer Biomet going forward?
Okay, the report highlights several critical factors. #1 probably is product adoption and market share recovery. Are those new products, Oxford, Persona OsteoP, Z1, Arso apps, actually gaining traction? Will they help ZBH win back share? That hits the core revenue.
And the robotics fight is central to that.
Absolutely. Right? #2, watch their competitive position in robotics, RSA versus Mako. Can ROSA really compete effectively, gain momentum against Stryker? Success of the new ROSA applications is key here for share, ASC penetration, implant pull-through.
And making the big acquisition work.
Yep. Third is execution of strategic initiatives, particularly the Paragon 28 integration. Is it smooth? Are they getting those cross-selling synergies? Leveraging the ASC channel for Paragon's products? That's crucial for diversification and set growth.
The whole shift to outpatient surgery.
Huge trend. Fourth factor, the pace of adoption of ambulatory surgical centers, ASCs. How fast does surgery volume really shift? And can ZBH maintain its leadership position there? Major growth driver, potential margin opportunity too.
Then there are the external factors you can't control.
Right. Fifth, the global macroeconomic environment and payer dynamics. Will a slowdown hurt elective surgery volumes? Will pricing pressure keep squeezing profits? Always factors.
And here's that really interesting, maybe unexpected one.
Yeah, #6, the potential impact of GLP-1 drugs on large joint surgical volumes. Could weight loss drugs like Ozempic actually reduce the long-term need for hip and knee replacements by tackling obesity?
It's a fascinating question, given how core those procedures are for ZBH.
Definitely something to think about. Then the financials.
Of course.
Yeah.
7th, financial execution and margin expansion. Can they hit those margin targets through efficiency despite pricing pressure and other challenges? That drives the bottom line.
Growth outside the U.S.
8th, international market growth and FX volatility. Can they accelerate growth in Europe, Asia? And how will currency swings affect the numbers?
The product pipeline we discussed.
9th, new product pipeline execution. Are those 50-plus launches happening on time? Are surgeons adopting them? Absolutely vital for long-term growth.
And finally, the regulatory environment. 10th, industry and regulatory trends. How will increased scrutiny, compliance costs affect operations and their standing versus competitors?
Okay, so there you have it. We've really dug into the CompassScope report and the latest updates on Zimmer Biomet. Covered their business from implants to robotics, the competitive landscape, especially versus Stryker.
Their growth strategy focused on tech, ASCs, and diversification with Paragon 28, the key execution risks like ERP and integration.
Their recent Q1 performance showing some solid momentum, and those critical factors to keep an eye on, from robotics adoption all the way to the potential impact of GLP-1 drugs.
Hopefully these insights give you a much clearer, actionable understanding of ZBH's position and potential in this really dynamic market.
And as you think about all this, really mulled over that question about the GLP-1 drugs. Could something seemingly outside the orthopedic world, like weight loss medication, fundamentally change the long-term demand for the core procedures ZBH is built on? How might the whole industry adapt? It's a great reminder of how interconnected things are, and definitely something to keep in the back of your mind as you look at companies in the healthcare space.
This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.